Good morning, everyone. Welcome to webinar 3 of our 4-part series regarding Form CT-PET and Form CT-1065 CT-1120-SI. Please note that this webinar will be recorded so you can revisit it and will be posted next week through our website ct.gov/DRS and within our Taxpayer Education Center link. So today I'm going to go over a recap of webinar 1 and 2, and we'll also go over an example detailing the following topics. Within the Form CT-PET, I'm going to explain a little bit further the subsidiary income and also unsourced income. On Form CT-1065 CT-1120-SI, I'll also elaborate on the calculation of Connecticut source income and the calculation of PE tax credits. And we will end with a schedule CTK1 and details with the composite and PE tax credits. So to briefly recap our webinar 1 and webinar 2, within the first webinar, there was an introduction to the Form CT-1065 CT-1120-SI and the Form CT-PET. We also reviewed the filing requirements and due dates, also how to use MyConnect, and you were introduced to the Taxpayer Education Center. And we ended with some additional resources available for you to visit. Within this second webinar, we went through an example of a completed Form CT-PET and Form CT-1065 CT-1120-SI. So now we're going to go through an example with a little bit more detail than what was in webinar 2. So here's the fact pattern. We have a pass-through entity that operates within and without Connecticut. They have federal Schedule K income consisting of ordinary business income of $330,000 and also interest income of $60,000. The pass-through entity also receives income from other pass-through entities. So in this example, they are a parent PE to subsidiary PEs. They also earn income in other states. And for simplification, we don't have any modifications in this example. The members include a non-resident individual with a 25% profit share percentage, a pass-through entity with a 15% profit share percentage, a resident individual with a 40% percentage, and lastly, a C corporation with a 20% profit share percentage. So the first topics we're going to go over is within the Form CT-PET. We're going to go over an overview of the subsidiary PE income and loss and unsourced income. So please note, unlike webinar 2, where we went through every schedule within the Form CT-PET, I'm going to focus more so on these topics, so you may not see every section or schedule covered that is in the CT-PET. So we are going to complete part 2, our allocation and apportionment of income first. Because the entity is operating both within and without Connecticut, we're going to include the gross receipts from services from Connecticut and everywhere to come up with our 60% apportionment fraction. Please note that the gross receipts are various, it's arbitrary numbers. There's no additional information that we have. This is just to include in the example. So we have $850,000 of everywhere receipts and Connecticut receipts of $510,000. Please note that we are reporting items of income from our own operations only. This does not include items from subsidiary PEs. So before we get into completing the return, we received income from 2 subsidiaries. Here are the Schedule CTK ones that we received. The first one, the example here, is from ABC. As you can see in part 2, we have the income that was distributed to us from the federal Schedule K1 of this subsidiary. We have ordinary business income of $80,000 and interest income of $40,000. That's noted in part 2, column A. In part 2, column B, that is the income from Connecticut sources. And in this example, it is 100% Connecticut. As you can see, column A and column B are equal to each other. So our Connecticut source income for ordinary business income is $80,000 as well. And our interest income is $40,000. Please note there's some additional information on this K1 that we'll actually go over later in another example. Here's our second schedule, CTK1, that we received from XYZ. As you can see in the highlighted section, Part 2, Column A is the amounts that this PE received on their federal schedule K1 from this entity. We have ordinary business loss in this example of $100,000. And once again, they're operating wholly in Connecticut, so column B is equal to column A. So our Connecticut source loss is also $100,000. So the first topic I'm going to cover is how are we determining our subsidiary PE income? So what we're going to do is we're going to take the federal amounts because that's what we're actually going to remove from the calculation of our federal amounts for our Connecticut source item, our subsidiaries, to determine our federal income from our own operations. So here in this example, we're going to add the ordinary business income and interest income from both the K1s we received, ABC and XYZ. When we add those two together, our ordinary business income actually results in a loss of $20,000. And then we only had interest income from ABC, so we have a total amount that we're going to report on Part 3, Schedule A, Column B, of $40,000. And let's see those calculations in action. So here is Part 3, Schedule A. As you can see in Column A, these are the total amounts reported on the PE's federal Schedule K. We're going to remove the amounts from the subsidiary PEs to come up with our own operations. So in this case, we have a loss of $20,000 in column B for ordinary business, and interest income of $40,000, which was our calculation in the prior slide. So we take column A minus column B to get us to our own operations, which you can see in column C. So we're going to take our $330,000 and subtract our loss, which results in $350,000 of ordinary business income. We're going to do the same thing with interest income. We take our $60,000 minus $40,000 to get us $20,000 of our own operating interest income. And in Part 2, we had an apportionment fraction of 60%. And in this scenario, we are going to apply that apportionment fraction to column C to determine our own Connecticut sourced income. So I will take $350,000 from column C, ordinary business income, and multiply it by 60% to get to $210,000. The same method will be applied to the interest income, which results in $12,000 of Connecticut sourced income. We're going to add those two together. As I said, we didn't have any modifications. We had no PE tax payments that we're adding back. So when we add those two together, we have total Connecticut source income of $222,000, which is noted on line 18, column D. So now we're going to take that $222,000 and apply the distributive share percentage for our taxable members, who would be taxed in the pass-through entity tax. As you can see, it's only 80% because C corporations are not included in this calculation. So we have a C corporation with a 20% distributive share. So we're only including the non-resident individual, the pass-through entity, and the resident individual. So we come up with a modified Connecticut source income of $177,600. The next line, line 4, is our resident portion of unsourced income. So we have not gotten into that example yet, but we have brought it up here as $37,200. We're going to add those two together to determine our PE income that's subject to tax. So topic number 2, how do we determine our unsourced income? So this has been a question that a lot of you have asked, and I hope that we can clarify it in this example right here. So I have down at the bottom just a snippet of our statute 12699A8, unsourced income. Please note, this is only a small portion of it. You can visit our statutes to review the full section, which really is the details of lines 1 through 4 up in Part 1, Schedule C. So what I want to focus on today is other states' sourced PE income. So this is to the extent that any such items are derived from or connected with sources within another state. That state has jurisdiction to tax the entity and actually imposes the tax on the entity. All right, so let's think about that for a second. Now I'll go through lines 1 through 4, explain where everything comes from, and then talk about line 4 a little bit further. So first, we're going to take all of our PE income. That comes from Part 3, Schedule A. That is the total Schedule K income that we had. In this example, it was $390,000. From there, we remove our Connecticut source income from our own operations, which is that $222,000 that we calculated. We also subtract any Connecticut source income from subsidiary PEs, and those were coming from our subsidiary PE Schedule CTK1s that we received from ABC and XYZ. And lastly, on line 4, we have our other state source PE income. So as you can see in the breakdown to the bottom right, we have other state source income from 3 states. And these are just, once again, arbitrary numbers, just for the example purposes of this example. So the first state is Florida, where we have other state source income of $10,000, Massachusetts of $37,000, and New York of $18,000. And you can see what was included in line 4. We only have Massachusetts and New York income because there was no tax actually imposed on the Florida income. So when in doubt, my recommendation is to say, or think to yourself, how would a resident individual report or include a credit for taxes paid? If they're going to include it as a credit for taxes paid and they've paid tax to that state, that would most likely be deemed other state source income and included on line 4. So we have reduced line 1 by lines 2 through 4 to come up with a net unsourced income of $93,000. And we're only going to include our resident individuals when determining our unsourced income. So in our example, we have one resident individual with a 40% distributive share, resulting in a total resident portion of unsourced income of the $37,200 that we had calculated and included on Part 1 Schedule B. And lastly, we're just going to wrap up our Form CTPET by showing Part 1 Schedule D. So as you can see, we've only allocated a PE tax credit to our taxable members. This includes our resident individual, our pass-through entity, and our non-resident individual. My apologies, I said it out of order, but our non-resident individual is member number 1. We have added the prorated Connecticut modified source income for all of these entities or members to the prorated resident portion of unsourced income. As you can see in column F, that was only for our resident individual. So when we add those together, we have the total PE income for each of the members that's subject to tax. We then determine the pass-through entity tax, and then lastly, the pass-through entity tax credit for each member. That is column I. And here I want to emphasize again that this PE tax credit in column I is transferred to the composite return. In no way should these PE tax credits be directly transferred to each of the members' Schedule CTK1s. There's actually a Part 8 on the composite return that will combine an indirect credit as well, which may modify the PE tax credit to distribute to each of those members. So please be sure to don't stop at the Form CTPET, that you must then complete the composite return in determining the PE tax credit to distribute to your members. And lastly, of Form CTPET, we'll complete Part 1 Schedule A. We're going to take our PE income subject to tax from our Part 1 Schedule B, multiply that by 6.99%, which should tie to our Part 1 Schedule D tax calculation. We have $18,000 of estimated payments made, as you can see on line 5A. This results and an overpayment of $2,986. And in this example, we have allocated that refund to two different ways. On line 10A, you can see that $2,000 was applied to the 2025 estimated PE tax, and then the remaining $986 was refunded through the PE tax account. We've completed our Form CTPET. Now we're going to go into the CT 1065 CT 1120 SI Connecticut Composite Income Tax Return. The two topics that I want to cover within this return is a detailed calculation of the Connecticut source income and also the calculation of PE tax credits. So we're going back to the Schedule CTK1s that we received from our subsidiary PEs first. As you can see, I've highlighted a different section here that I want to focus on. None of this data has changed from the K1 that I showed you before from ABC. We're just now looking at Part 3 and Part 4. Part 3 is the composite payment that was made for this pass-through entity. This totals $1,049. Part 4 is the pass-through entity tax credit that was paid for this pass-through entity, totaling $7,340. Now let's see where that goes on the composite return. Oh, I skipped. First off, we have our second K1 from XYZ. And since we had an overall loss, we should not see any composite payment or PE credit issued to our entity, our pass-through entity, because there was no income to pay a liability for. All right, so we've taken those two Schedule CTK1s from our subsidiaries, and we're going to enter that information on Part 1 Schedule D. So as you can see, we have the information for ABC and XYZ. We have the amounts reported on the federal K1. And mind you, we received CTK1s from this entity, so we can use the column A of Part 2, or we could also include the federal Schedule K items that we received on the K1, the federal K1 that we received. All right, so if the entity is not conducting business in Connecticut, you might not have received a Schedule CTK1. You would still include that if you received a federal K1 from that entity. So column A are the amounts reported on our federal K1. In column B, we're going to add the amount from Connecticut sources to complete this section. So for ABC, let me say XYZ, we had an overall ordinary business loss of $100,000, and that's where that is included. Columns C and D are the composite liability and pass-through entity tax that was reported on Parts 3 and 4. So you can see from that Schedule CTK1 from ABC, we have the composite liability of $1,049 that was paid for this PE, and then the PE credit of $7,340 that was paid for this PE. Next, we're going to complete Part 2, and this should look very familiar. We just finished this in the CTPET. There should be no difference here. So as you can see, we still have a 60% apportionment fraction. And then just to reiterate, in this part, we are only including sales and services from our own operations. We would not include items, sales or services, from subsidiary PEs here. Next, we'll complete Part 1 Schedule C. And this is where we're going to pull out our federal amounts from our subsidiary PEs. So this should look familiar as the PET return that we just completed, Part 3 Schedule A. So we're going to take in column A, the amounts reported on our federal Schedule K. We have ordinary business income of $330,000 and interest income of $60,000. In column B are the federal amounts from our subsidiary PEs. We had an overall ordinary loss when we add income from ABC and XYZ of $20,000, and then interest income of $40,000. Very similar to Part 3 Schedule A again, we're going to take column A minus column B. These are the federal amounts from our own operations, and that is what we will end up apportioning when determining our Connecticut source income. So speaking of Connecticut source income, here's topic number 3. Here's a detailed breakdown of how Connecticut source income is calculated. So I've pulled my federal income from the PE's own operations. This came from Part 1 Schedule C that we just completed on column C. So we've got ordinary business income of $350,000 and interest income of $20,000. We're going to take those items of income and apply the Connecticut apportionment fraction of 60% that we had just calculated. That creates a $210,000 ordinary business income from Connecticut sources and $12,000 of income from interest. Now I have a little asterisk here because we are applying the apportionment fraction to these items of income. Not all items of income are subject to the apportionment fraction. So please, if you have any questions, you may revisit the form for the composite return, which will give you some additional details. All right, so back to the calculation of Connecticut source income. So in column B, we've determined the Connecticut source income from the entity's own operations. We're then going to add the Connecticut source income from our subsidiary PEs. That has already been determined on our Schedule CTK1s that we received from those subsidiary PEs. So column C shows the Connecticut source income from ABC, which is from the Schedule CTK1, Part 2, column B that we received from ABC. The same thing with column D, our Connecticut source income from XYZ, which was an overall ordinary business loss of $100,000. So in column E, we're just going to add up all of the items from Connecticut sources. We're going to take column B from our own operations, add it to column C from our subsidiary entity, and column D from another subsidiary entity. This results in ordinary business income of $190,000 and interest income of $52,000, which now we'll allocate to our members. So here's a completed Part 6. What we've done is we've taken the total Connecticut source income and applied it to the members that are included in the composite return. So I've completed this from member number 1, who is a non-resident individual. And in the calculation below, you can see that they are 25% profit percentage. So I just multiplied their profit percentage by the total Connecticut source ordinary business income and interest income. I did the same for member number 2. This is a pass-through entity with a 15% profit percentage. As you can see, I did not include member number 3, who's a resident individual, and member number 4, who's a C corporation, because they are not subject to the composite tax and do not need to be included in Part 6. Right, so we've determined our Connecticut source income. Now let's allocate the PE tax credits that we've determined from our Form CTPET that we just completed, and also the indirect credits. So some of the question has come up as to, if I receive an indirect credit and not all of my members are taxable, how do I allocate that percentage? So as you can see below, there is a calculation to prorate that indirect credit to the members who are entitled to it. So in this example, our C corporation member number 4 is excluded from this calculation. When we completed our Form CTPET, they weren't included. So all of the amounts completed on that form directly transferred over onto column B. So those items come right from the Form CTPET that we already completed. Column C, though, if we were to allocate that total indirect credit using our members' current share, it wouldn't be allocated entirely. So what we do is we take the member percentages of all of the members that would be included to receive the PE tax credit. So below you see that I've added my 25% member, my 15% member, and my 40% member to come up with the total percentage of 80%. I then take each member's percentage and divide it by that total. So member number 1, when I take their 25% member percentage and divide by 80%, I come up with a prorated percentage of 31.25%. I do the same thing for all of these members. And as you can see, now the total equals 100%. I can now allocate that indirect PE credit to those members to result in the full indirect credit being allocated. So as you can see, the $7,340 from Part 1 Schedule B is now allocated wholly to members 1, 2, and 3. So we're going to take the PE tax credit from our own operations or from our own Schedule CTPET and add it to the indirect credit in column C to come up with the total PE tax credit. Now from here, in column E, we're only going to include those that would be reported in the composite return. And we'll get into that a little bit later. But as you can see, I only carried over member 1 and member 2 into column E. Member number 3, who is a resident individual, will report that entire amount in column D on their Schedule CTK1. But for the members that are included in the composite return, we have one additional step before determining what their PE tax credit actually is. So please mind you, as we've added that entire amount up from those taxable members, in column E, we have $9,101. So we've determined our Connecticut source income. We've determined the PE tax. Now let's put it all together. So on Part 1 Schedule B, we're going to include only the taxable members for the composite return. That's our non-resident individual member number 1 and our PE member number 2. We've added our total Connecticut source income for each of them to come up with, I'll just use as an example, member number 1 has $60,500 of total Connecticut source income. Multiplying that by our tax rate of 6.99%, the liability is currently $4,229 for that member. We have no members credits. Those are the income tax credits that we talked about in webinar 2. That would be like the ABLE, the angel investor. So in this situation or example, we don't have any credits. So we have an overall liability still of the $4,229. The PET credit that I'm going to allocate to this member cannot exceed that amount. So in this example, column G is going to be equal to that because as you can see, I have a snippet from Part 8. The PE tax credit that was allocated on Part 8 for that member is $5,688. But it can only be limited up to their liability. So what is going to be distributed to that non-resident individual is a PE tax credit of $4,229. I'm sure you're all saying, wait a minute, where does that extra credit go? So any excess PET credit, so the reason we have an excess is because we had a loss that offset our income. So any excess PET credit is refunded to the PE filing the return, not to the members of the PE. So all of the members have just had their 6.99% liability paid for. So you can see it all come together here. On Part 1 Schedule A, we've added our total Connecticut source income from Part 1 Schedule B for all of our members, which results in income of $96,800. Our income tax liability for those members is $6,766. We're going to apply payments that we've already talked about. We have our Part 1 Schedule D composite payment from ABC of the $1,049. We have a PE credit, though, from the Part 8 that we completed, column E, of there it is. There's the $9,101. So even though the members were allocated up to their liability, this pass-through entity claimed all of that PE credit for those taxable members, which ends up resulting in a refund to the pass-through entity. So as you can see, our payments are greater than our liability. So the pass-through entity receives a refund of $3,384. And lastly, I'm going to go over a Schedule CTK1 that is being issued from this pass-through entity to a member. We're going to go into detail the calculation of the composite and PE tax credits on this Schedule CTK1. And just a disclaimer for purposes of time, the following examples only for the pass-through member. Please note that the pass-through entity filing the composite return must distribute Schedule CTK1s to all of its members. So here is the completed Schedule CTK1 that the pass-through entity is distributing to its own pass-through entity member. As you can recall, they were member number 2 with a 15% distributive share percentage. So here we have part 1. There were no modifications in this example, so this is blank. Part 2 is going to show the amounts that were distributed through the federal Schedule K1 in column A. And then in column B, our Connecticut source income that was determined on the composite return, part 6. This is $28,500 of ordinary income and $7,800 of interest income. What I primarily want to focus on, though, is how part 3 and part 4 were determined in allocating these credits to the members. So as you can see, part 3 is the composite liability that was paid for the pass-through entity. Why is this 0? Well, actually, all of the pass-through entity tax credit that was reported to this member covered the potential composite liability. So the entity is receiving a PE tax credit of $2,537, which should cover the liability for all of their Connecticut source income. And as you can see, the calculation in the composite section, part 3, is the total amount from part 1 Schedule B less the pass-through entity tax credit that was distributed to that member. So this is a lot to take in. A lot of the instructions are right on the forms. So please look through the forms. And if you have any questions, we'll talk about that later. But I have some resources that I want to emphasize again. There's some great information on our information page for both the composite and pass-through entity tax. Also, I've referred to the forms throughout this presentation as well. And so please go to those forms. There's a lot of instruction in there as well. Lastly, we have recently issued a TSSB 2025-4, which goes over the filing methods for the pass-through entity tax and composite. So I highly recommend you take a look at that. And also, new news, this didn't make it into the resources, but there's also going to be another TSSB 2025-5 issued and on our website later today to talk about the due dates and filing requirements. So once again, I highly recommend that you take a look at that either later today or early next week. We'll also address a lot of these items in our next webinar. So before I say goodbye, webinar 4 is going to focus solely on frequently asked questions. So we are hoping to get out another TSSB to cover some of those frequently asked questions. In addition, you will also receive a survey after this presentation. If you have any questions that you would like included in webinar 4, please use that and respond to us so we can include it. I appreciate your time and have a great day.